Hello, my friend. Welcome to Charlie Retail Invest. Let's track the latest trend in US economy and share our in-depth analysis and recent investment in stocks and bonds. Berkshire Hathaway, led by Warren Buffett and his management team, released its Q3 financial report last week. Among the updates, the most eye-catching information from Berkshire Hathaway is that they've built more than $325 billion of short-term treasury bonds, essentially cash reserve in their balance sheet. This number is over 20% increase relative to Berkshire's cash reserve back in Q2 of this year, which was $276 billion back then. Moreover, Berkshire Hathaway has halted its share buyback program in Q3 of 2024, which it had been consistently doing for the past several years. What it means is that Buffett thinks the valuation or the stock price of his own company, Berkshire, is too expensive and it's not worthy to conduct stock buybacks at this elevated price. This actually led to a sell-off of Berkshire Hathaway stock on November 4th, because investors were spooked by Buffett's thinking that Berkshire's stock price is overvalued and he himself was reluctant to buy his own company stocks at over $440 per share. However, we think the cautiousness of Warren Buffett and Berkshire does make sense, and it's especially the case that the current bull market has sustained for over 2 years, from December 2022 till now. Even though the bull rally may not end in the next few months, we have to admit that the bull market has already passed its half point at least. So in the coming year of 2025, many analysts and institutional investors anticipate that the rate of return for US stock market in general to be much lower than that in 2023 and 2024. To make matters worse, the earnings of major companies may have decreased year-over-year growth when we are heading into the second half of 2025, which means that many large cap stocks might drop in price in Q3 or Q4 of 2025. And we all know that Berkshire Hathaway holds hundreds of millions of stocks on hand. If Buffett waits until the stock market begins to crash and tries to sell his stocks then, it would make his asset prices drop by 30% or more in value instantly, because he has held such a large volume of stocks to sell. So instead of panic selling in late 2025 or 2026, Buffett starts to offload stocks continuously in 2024, such that his sale prices can remain at a relatively higher level when market sentiment is very good and everyone believes that the bull market will sustain for a long time. And it will take him several quarters or even years to sell a significant portion of his stock portfolio, while making sure that the sell-off itself doesn't bring down the stock market. For retail investors like ourselves, Buffett's strategy may not be the best option for us, because our stock holdings are minimal compared to Buffett's, and we can ride the bull market rally until the very end, and then sell our stock holdings in a single day if needed, without causing any effect on the market itself. So that's the benefit of being a retail investor, is that we can always change our positions quickly and be very flexible as the market momentum changes. However, the majority of big companies are doing the opposite to what Berkshire Hathaway and Buffett had been doing. And a typical example is Apple. Apple has started its stock buyback program in the third quarter of 2024, with over $100 billion consumed to buy back its own stocks at a near historic high price of over $220 per share. There are two main benefits for doing stock buybacks. One is that it pumps up the stock price, as the number of shares in the open market decreases as Apple is purchasing its own stocks. The second benefit is that for Apple's CEO Cook and his management team, this is because when Apple stock price is above a certain number, their bonuses, which largely comprise of stock and stock options, will be astronomically higher than their target levels. That means Apple's executive teams will receive tens of millions of dollars in 2024. However, the downside of doing share buybacks is that Apple is using up its cash right now, and they may need more money in the near future when the economy is not so strong and their cash runway is somewhat restricted to maintain their business growth. So essentially, they have sacrificed their future growth and performance of their stocks for the instant rewards of their leadership team for now. Let's take an example on how Apple could better use its cash reserve than buying back its own shares at a costly price. We know that Apple wants to manufacture its own chips for its PC and iPhone products. And right now, Intel's market value is at a historic low of $104 billion. Apple could have used its $100 billion to buy Intel rather than buying its own stocks to build up its infrastructure of chip manufacturing. Of course, this is not to say that it's a smart move for Apple to buy Intel as a company, but there are certainly better ways to make use of the extra cash on hand. Another option for Apple is to increase its dividend yield and pay back to Apple shareholders with those extra cash, rather than buying back its own shares to benefit its CEO and CFOs. Let's talk about the US stock market. The election day is here, and on November 5th, all the votes for the president will be collected, and from what the betting market suggests, the chances of Trump being the next president is still significantly higher than that of Harris. The key reason that voters choose Republican Party over Democrats this time is because under the Biden and Harris administration, their huge government deficit spending and Inflation Reduction Act has kept pumping money into the financial system. Unfortunately, those money did not go into American people's pockets, but rather benefited large corporations like Nvidia, Walmart, and so on. While the Federal Reserve has kept benchmark interest rates above 5% for the past 2 years, it certainly didn't affect those big companies because they still have huge cash in hand and do not need to borrow money at a higher rate. To make matters worse, average Americans now face the high mortgage rate, credit card interest rate, and high prices for everything, as the interest rate had been kept high. So we are seeing a contrarian situation where average citizens have a very hard time living and people are getting laid off from their jobs everywhere, while the stock market keeps going up because those large companies keep making loads of money. So that's the main reason why people have been fed up with the current administration and would like to explore a new possibility under the Republicans and Trump now. Of course, the outcome might still be the same. That is, the gap between the rich and the poor gets bigger and bigger, regardless of who is in charge. This is mainly due to the fact that the Federal Reserve can print as much US dollars as they want to inflate the financial system. The government can also borrow as much money as they'd like to for various purposes. And the rich people, including those senators and congressmen, have already had enormous amounts of assets, such as stocks and houses, and inflation will just make their net worth go much higher in the future. As retail investors and average people, what we can do now is to follow the trend and make some money along the way. And that's the only thing that matters to ourselves and our family, regardless of what the media says or what the government officials promise. Anyway, we might be able to see the presidential election results by the end of November 5th. However, there's also a good chance that the defeated candidate questions the election result and file a lawsuit against it. If that happens, we will need the Supreme Court to make a final judgment on the election results in late November, which means that the stock market may have sustained high volatility for the next 1 to 2 weeks, and we may have pretty good buy the dip opportunities when volatility is high. As we move into the presidential election timeframe, the Greed and Fear Index, as reported by CNN, has shifted from greed and even extreme greed in mid-October to fear territory now. If we look at the stock price strength and breadth charts, we can see that starting in mid-October, the number of stocks that go up in price as compared to stocks that go down in price has been decreasing for several weeks straight. That means although the stock index looks okay, underneath it, many medium to small-sized company stocks have tanked by a lot as we move into the presidential election season. Right now, if we look at the stock market, we can clearly see that fear is building up. And in the short term, we may see many stocks keep falling in price. However, we can still find some really good stock index ETFs and individual stocks that might be worth buying at a relatively discounted price for November. I would recommend looking at DIA, which is the Dow Jones Industrial Index ETF, SOXX, the Semiconductor ETF, XLV, Healthcare Sector ETF, as well as Berkshire Hathaway stock. In addition, Microsoft and Lockheed Martin stocks are also worth looking at because their prices have been dropping by a significant portion lately. And after the election, they are likely to bounce back in price such that we can make a profit or just hold them for long-term investment. Unless something really bad happens like 2008, the global financial crisis, or the 2020 COVID pandemic, all these large cap stocks and ETFs don't seem to have a large downward risk for now, which is very different from those meme stocks or small cap stocks. Let's move on to discuss the bond market. The 20-plus year long treasury bond ETF, TLT's price has been bouncing up strongly this week, after a month and a half bleeding since mid-September. As its price moved up from bottom on November 1st, it now reaches above $92.8 per share and is trending higher. At the same time, 10-year Treasury yield has decreased from a high of 4.4% on last Friday to 4.28% on November 5th. We believe the turbulence in bond market last week was largely due to the presidential election speculation. Now that the election result will be determined very soon, bond market volatility will go down, and that's good for bonds to recover in price. Moreover, the new jobs number, non-farm payrolls, and labor market updates on October looks pretty weak to say the least, and that settles down the market's worry that inflation will come back quickly. The Federal Reserve will have its next FOMC meeting later this week, and market now is fully prepared for the Fed to cut by another 0.25% of the benchmark interest rate, making the overnight interest rate 4.75%. As we move along the next few months, benchmark interest rate will continue to go down from 4.75% to around 3 to 3.5%, and we believe the 10-year bond yield will reach a level around 3.8 to 3.9% accordingly. For our bond investors, it might not be the best time to sell our bond positions right now. We can hold and wait for another 1 to 2 months after the 10-year bond yield comes down to 3.9% or lower, or TLT's price goes above $96 per share, and then consider selling those bond investments and secure the profits. Needless to say, we choose to hold some bond positions as a hedge to the stock market volatility. If a black swan event happens that triggers recession, stock market will plunge and TLT's price will rise above $105 or $110 per share very quickly in a week or two. Even if the economy is good and there's no recession, bond price will go up slowly and give you the fixed income in the meantime. Here is the CRI investment portfolio as of November 5th. We still hold TMF, the 3 times leveraged 20-year Treasury bond ETF, as our largest holding, with a weighting of 49.1% of the entire portfolio. We expect TMF's price to go above $56 per share in the coming month. Lockheed Martin stock, LMT, is our second largest holding, with a weight of 10.9%. We've been buying LMT since mid-October, and we'll hold it as long-term investment. The third place comes for UST, which is 2 times leveraged to 7 to 10 years Treasury bonds. We also have UBT, the 2 times leveraged 20-year Treasury bond ETF, as our 5th largest holdings. We might sell some UST and UBT after TLT's price goes above $96 per share. Occidental Petroleum Company, or Oxy, is our 4th largest investment with a weighting of 6.6%. The oil price has been dwindling down for the past month or so, and we may see oil price go back to a higher level in 2025. So we will hold Oxy and our energy investments until next year. The 6th place goes for SOXSXX, the semiconductor ETF. We've also added some exposure to tech stocks, including Google, Microsoft, and QQQM, which is equivalent to Nasdaq 100 Index ETF, QQQ, but with a slightly lower maintenance fee. For the past few days, we also bought some Berkshire Hathaway stocks at a unit price of $443.6 per share. We will hold those large cap tech stocks and brkb as long-term investments. Overall, we are still overweight in treasury bonds and will gradually sell some bond positions with profits as their prices get higher, and buy the dip in stock indexes when volatility and fear is high. If there's any big news or significant change to the current market trend, we will keep you posted in the real time. So that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charlie Retail Invest. We really appreciate your help. You can also leave your thoughts on the stock market and our economy in the comment section below. Thank you so much for your time, and I'll see you in the next video. Please take care.